Hello and welcome back. We were discussing about the various types of costs which are there and what are the various types of analysis which we can carry out onto the cost by which we can take our decision more effectively. So in this session, we will be discussing about the cost and revenue analysis. What is cost of and revenue analysis? So this revenue analysis, cost and revenue analysis basically means firstly we do the cost and analyzing the various component of the cost which is there in the organization, and same way we'll do the revenue analysis, which are various component of the revenue from where the revenue is coming, and then finally try to match the cost and revenue, that is called cost revenue analysis together. So first let's analyze the cost analysis. What is cost analysis? So we study each and every component of a cost. So how we do it? We put a various component of the cost which are there in the organization. Let's say you having a cost of material which are being used, raw material cost. Then you having a cost of production, which are being the all machinery and everything which are being used in the cost. And then third is the cost of marketing, then cost of administration, cost of accountants and accounts and finance department, and then overall there is a HR cost which are there in the organization. So these are the various costs which we divide our organization into different components. Now this depends upon the industry to industry, organization to organization. The ratio of the different costs will vary. If you are not a manufacturing organization, you are a service organization, your HR cost will be higher. On the other side, if you are a manufacturing organization, your raw material cost or material cost will be higher, and your other costs will be lesser comparatively to the other industry. So it's all depend upon the industry where you are. So purpose of doing is to look into the various components and how this component is changing over a period of time. So that will give us the idea whether my cost is increasing and which particular head cost is increasing rapidly or not increasing rapidly, so that we can manage which part of the component of cost which will require a better control. So that is we can determine with the help of cost analysis. Second analysis which we do is the revenue analysis. In the revenue analysis, we again divide the cost. We look into what are the various sources of revenue. Just like if a government or let's say a hospital is there, a hospital will look into what are the various sources of revenue which is coming. So it will be looking into which department is giving which, how much revenue is coming from which department. What revenue is coming from pathology? What revenue is coming from the let's say the pharmacy, or same way we will look into the different departments' contribution, and then revenue contribution. Other than that, is it we are getting some money from the student fees if we a medical college component is also added, or we having some money which is coming from the we having a property which was we given us something on rent, so rent is being paid by the people, so that is revenue money, or we having some corpus money which is being kept in the bank fixed deposit and interest is coming over it. And then we also may have another source of income. Some donations are being given by volunteer by the people or by alumni or people or the patient who get corrected, and they pay to us as a donation money which is coming to us. So various component of the revenue which are there. So we analyze each and every revenue component from where this revenue is coming, and we analyze which component is increasing over a period of time or which is component decreasing, and which are my high performer or low performer departments. We can decide on the basis of that. And finally we try to match now with the cost and revenue together. That matching concept we apply. How much is one particular department is the cost to me, and how much is the revenue it is being generating from this department or this particular activity. So we try to match, and we look into which department is high contribution and which department is a low contributor, or which source of income is low contribution, which source of income is net income is less contribution. So by that analysis will help us to improve the efficiency or effectiveness of the organization. So once we are able to do that analysis, the second step comes into the picture is what are the various strategies by which we can do the cost cutting. This is one of the very most common issue which all government organizations most of the time face. The orders come from the top, go for cost cutting measures. So what we look for, where should we look for, how to cut our cost? For that matter, cost cutting, there are various strategies which are available with us. So first strategy is called substitution. Look for a substitute. You having a product, just like you are using a branded product, and can we use a generic product instead of that, or one particular supplier who is giving us the higher price, we'll look for the lower price supplier, that is substitutions. Substituting with a, we don't want to compromise the quality, but at the same time, keeping the quality constraint in the mind, we look for a substitute product which is lesser price available, so we can go for that particular product or the services which is available. And second is economies of scales. So how we cut down our cost? We go for economies of scales in the sense that we increase the production. So with the increase in the production, what will happen is that you have economies of scales in terms of, because you are able to produce more, your fixed cost will will remain constant, and your variable cost is just increasing. So by that you are able to use your 100% capacity. Now other technique which is called cost sharing. Now what this cost sharing is, that you share your resources with the other departments. If I have a particular machine which is being there in my hospital or in my organization, we can share with the other department. Let's say the photocopier machine is there which we purchase, it's a very high cost machine. So rather than being purchased in other department at a similar cost, or a color printer which you have purchased, so which can you using only 10% of it or 20% of it time. So other department also need it, you can share the same thing with the other department. So that's a cost sharing strategy which you can use. Other strategy which we normally use is a bulk purchasing. We buy, when you buy in the bulk quantity, you will get some quantity discounts. So that by bulk purchasing will reduce your cost. That's another strategy which we can use. And finally, reducing the idle capacity. In any organization, if I have some kind of idle capacity which is existing in the people those are wasting time or not able to spend time, get rid of that idle capacity. That concept which I normally don't agree. I normally believe everyone is a contributor in the organization. If somebody is not able to contribute, then get only the last chance is to get rid of that particular idle capacity which is there in your organization. Sell it off. That is it may be some unit which is you are not able to handle at all. You can sell that particular unit, or you can get that particular unit outsourced to some other organization, by which you can reduce your cost. From the revenue side, we having a strategy which is called cross subsidization strategy. This cross subsidization strategy is again we use that charging more money or charging the full price, or at one particular place or which is having a high demand, you charge there more, and cross subsidize with the other unit which is not in demand, so you charge lesser there, so that more demand can be generated for that particular thing also. That is one way of doing it. Or another way is increase the volume of the thing which you are which is not which is having a lower price product. You increase you play in the volumes. So you play in the volumes in the sense you with the lower price you increase more demand, and the more demand people will come with, and that's way you will able to recover your cost. That is another cross subsidization measure by which you can do the revenue generation. And the last is again using the same facilities for different purposes. That is again cross subsidization or cross substitution. Just like now your school building, the government, Delhi government is having a school building, so which they are using in the daytime for teaching to the one type of student, and in the evenings you can use that same building, because when the students are not there, that same building can be used for adult education or for the training programs or other things. So that is where we are cross utilizing the resources and earning the more and more revenue. Another strategy which we use in the minimizing the cost, or you can say the effectively utilizing our resources, is called responsibility center accounting approach. Now what is this responsibility center accounting approach? It is that you create a special business unit, SBUs, in the strategic business units in each and every part of your organization. So in these SBUs, what we do is every person you will make, you divide the organization cost center, profit centers, and then investment centers. Cost center is the center from where only cost can be coming in. So they cannot earn any money. So these are the people, those are cost center people, just like for example in an organization, accounting department or the administration people, they are the cost centers. They are not able to earn any revenue from themselves. And second is your revenue center or your profit center, the people those who are earning revenue and they are spending cost also. So we make them the profit centers and tell them you are the responsible in charge for maintaining the profit of this particular center which is given to you. You empower the people by giving them authorities and giving them some responsibilities, and those responsibilities are definitely with accountability being fixed to them. So they work hard and they try to maintain not only profit, they try to increase the profit of their centers by following ethical practices, not unethical practices that for which you having a checks and balances and controls are there within your organization. So that is the investment center person will finally there is an investment center person who is basically the head of the organization, or you can say the board of directors or the board of trustees, which are managing different profit centers and all together the cost center also. So they look overall as a investment picture and they tell to the each center whether to do for cross subsidization efforts are required. From this center profit is coming, can we transfer to the other center, or from this center profit is coming less, so we motivate them or appreciate them. So that work is done by the investment center, and they also look for the long term strategies for the future, from where which extra money which we are putting in, from where we can start the earning more money in the future years. So that is the focus of the investment center. So with this responsibility center approach, you give people authority rights and they try to contribute to the organization for the more effective contribution. This type of approach is very useful in the institution, just like academic institutions. It may be useful for the government services departments which are providing services, autonomous bodies, hospitals, organization. This type of approach is very much useful. Thank you very much, friends, for your patient listening and your active participation in this particular course. Thank you very much.